Good afternoon, traders. This is Michael and Paul coming to you from GammaEdge on Sunday, April 3rd. Today, we're going to be discussing how to make our GammaEdge tools actionable using positive trans and positive GEX as a core trading plan to your system. Paul's done some back testing with some interesting results, so we're going to discuss those. Go ahead, Paul, take it away.
Thanks, Mike. So before we get started, go ahead, pause the video, read this, of course, and just note you're responsible for your own decisions, and we're not. As Mike said, we're going to look at a strategy today. They rely on our dominant GammaEdge levels, and we get questions about this, so I thought it would be useful just to cover these at a high level. These are the ones that print on the charts automatically. And so we're going to really focus on two of these today, the positive gamma exposure or PGEX and positive trans or PTRANS or positive transition. These are remarkable in that the positive gamma exposure is a strike that has the largest positive gamma exposure in the complex, in the option complex. And PTRANS is the positive transition. It's the strike where the net gamma turns positive in the complex and remains positive above that. So as strikes go up, you're in this positive gamma environment. The reason we're going to choose these today is that we typically see, in general, price move upward towards positive gamma as we advance there. So we can demonstrate that, and we'll be talking a little bit more about that here today. So one of the questions we often get is price moving up through PTRANS from below. It's been observed that this is a key level for long positions. Is there an edge? And as it turns out, when we peel back the curtain a little bit, there does appear to be a definitive edge, and it's improved when we combine that with some simple TA. So what we're really going to focus on here today is this positive transition, this positive GEX, and entering when we get a crossing of positive trans with a target of hitting positive gamma. So the entry setup is really straightforward. It's looking at yesterday's close, and we just want to make sure that's below the positive transition level. And today's close is above the positive trans, and we want to make sure that positive trans is below positive gamma exposure. This is a fairly straightforward approach. You can do this at the end of the day. The data that is presented to you and as tested here, as you'll see, actually has you entering at the open of the next morning. So we're in pretty good shape there. The exit criteria when you hit your target is very straightforward. The close is above positive gamma, and you'll see that here on a chart on the next slide. Or the close is below PTRANS. If we have a failure here in positive transition and the spot price or the close actually goes below that into the close, we want to make sure we get out of the trade, and this is the fail safe to do that. So when you get into the Discord, you can run chart commands as well as text commands, and this is the output from those. And taking a look at the entry setup of what I just covered, here we have the SPY, and the overall charts for the SPY are pretty straightforward. Basically, it gives you the time of the chart, it gives you what the price was at that time, it gives you the total open interest, and then it, in this particular case, it's including all expiries, as you can see here, 22 through 2028. What we're seeing here, a couple moving averages on the chart, and you can see various levels that are printed here on the side. Sometimes the charting labels overlap like they did here, and you can run another command at the command line there to give you the text outputs. And what I want to draw your eye to is that we had a situation where the spot price or the closing price, because it was the end of the day, the 443.86, 443.86 is sitting right here, and here's positive trans. So we meet that first condition that the close, yesterday's close is below positive trans, and then today's close is above positive trans. So you would want to pay attention to your favorite index here, and you would want to see, is this condition being established? And then on the following day, again, one day later, so this was the 23rd, now we're on the 24th, positive trans is here, and you can see the spot price is actually closed above. So yesterday it was below, now it's above. And so that would be your potential signal to go ahead and get in provided that positive trans is below positive GEX. And so positive trans is sitting right here. Here's the positive GEX sitting right here, and you can see it's below. So all three criteria are met. Day prior, today's action, we meet the positive trans and the being below positive GEX, and so you would go ahead and place the trade the following day. So that would advance, and you would do whatever you're going to do. Typical length for these trades are about 4 days. So here we are out onto the 29th, and in this particular case, you can see that we're looking for a close above positive gamma. And so every day you would be looking for the close below positive trans. It didn't happen in this particular case, so I'm not going to walk through that day by day. But the close is above positive GEX. And you can see here's plus GEX at 460, and we actually did close at 460.95. So we meet the condition for exit, and you would simply exit at the open the following morning. Visually, you can see what that looks like. Now, for the astute observer here, you probably realize that positive GEX actually advanced. We see this all the time. We see as price advances, gamma advances, and that's because people are buying calls. And when we see those calls being added out and up, we actually see the advancement of positive GEX, and that helps give you some of that upward movement that you see there. So I think the takeaway is that we have the tools and the setups for this. I'm going to toss it back over here to Mike because he played this in a way that he used a leveraged instrument to play off of the SPX or the SPY, excuse me. And Mike, why don't you go ahead and give some description here?
Sounds good, Paul. I think one of the important things to remember here is these leveraged ETFs are basically just a proxy for the underlying, and the signals that are generated in the system that Paul is discussing, you can use for other ETFs like these leveraged ETFs. There's a few other ones out there that are 1x or 2x that will also provide some outsized returns comparative to what Paul's discussed there. So the same entry signal was here on the 24th. You could have entered on the 24th there, yeah, with the stop below. I think it's important on these leveraged ETFs to understand that the risk is higher with these, so you want to position size correctly, and then make sure you have the correct position size in your account if for some reason the exit signal is generated before we get the advancement. But as you can see, these continue to advance. Obviously, the moves will be a little bit more volatile than the underlying, so you can continue to trail your stop up. And I encourage people to use a tier out type system depending on what your share size is. So if, let's just, for example, say you took 50 shares in your account, you could begin to start trailing 25 shares up at, you know, a 2 or 3% gain. That way, if this did come all the way back down, then you're going to lock in profits. We saw this go ahead and advance on the 28th, and then the 29th was a gap up. That would have been a good area to manage risk and take profits there. Then we got the continuation up on the 30th, and then we got the exit signal the next morning, which would have been an excellent exit signal, as you saw with the underlying up into that overhead positive GEX, and then we continued lower from there. You could have tiered your stops out. If you like to do TA, some simple moving averages could have also been the exits, some shorter term moving averages. But for a core system, I think it's important to focus on percent gain and percent exit. So you could have exited with a 2 or 3x compared to what the historical trades that we've looked at. So I think it's just another way to have outsized gains and be able to manage your risk appropriately.
Right. Well, thanks, Mike. So I think one of the key things here to show the edge, we use a new capability. We're working with a company called EdgeRater, and we have some software that we're helping, basically collaborating together to bring effectively what is the GammaEdge levels into a major historical database. I will note that right now GammaEdge data is not available in the EdgeRater Pro production product from them, but you know, that may change in the future, and you might be able to get our data going forward, so you could do your own tests. The real key here, though, is it really opens up a lot of our capabilities to look at history and look at what what could be. So when we take a look at this backtesting of positive trans and this positive GEX exit, what we wanted to do here is we're starting first with the index ETFs, the SPY, the Qs, and the IWM. And we're also going to couple this with something very simply called IV rank, or implied volatility rank. And you don't need to know the exact numbers. Really, what you need to know when we talk about implied volatility is that the ranking, which is 0 to 100, if the numbers are extremely low, then you know effectively that we're in a low volatility environment. And you can just look at the SPY or look at the Qs and know, are we in a major a dynamic environment, or are we in a lower environment? And the key here is that we want to be in a lower environment. So this there's a lot of information here. I'll just cover it at a very high level. We did a test which is called a Monte Carlo test, and what that basically is it looks at 1,000 different ways of making the trade. And why that's important is that there's sometimes path dependency. As we take a trade, we lose capital in our account, and we can't take the next trade and things like that. Well, what this does is it helps us understand what could happen if we only take 50 of 1,000 trades at a time, or some proportion of trades at a time, and just see how the results come out. And what the two key takeaways, say that 5 times fast here, are that we want to look at something called the final equity, or FE, and we also want to look at how much pain would we take if we were to place these trades. And one of the key things is that for low volatility environments, you can see that the average return per trade gets bigger as volatility gets smaller and smaller. And we want everyone to realize that there is a direct correlation to lower volatilities to actually doing pretty well in the performance here. Another thing to take a look at here is what's called max drawdown. Drawdown is how much pain you feel intra-trade. Now remember, as I said earlier, the trades are only about 4 days long. So you're only in this trade a very, very limited time. Mike and I were talking earlier, and basically we're presenting this trade once a week or once every other week or so. So for 4 days, you're going to take some gains there, and you're looking at the individual equity here, not an option, but you're going to get about a 0.5% gain for those 4 days. And if you use, as Mike just presented, if you use levered ETF, you might get a little bit higher here. The key takeaway, though, is that on average, and you saw with that last one that we actually advanced quite a bit, that you actually have what's called, when we look at the final equity, the 50 percentile, this is the average. We expect over a large number of trades to be able to make a fairly substantial amount in the overall equity of our system. What's even more important is that when we look at what's called FE5, or that's the tails, think of that as not occurring very often. When that number is above 1, what we basically are saying is that 95% of the time, we're going to, if we, over a large number of trades, we're actually going to be adding to our overall equity within the system with a high confidence level. So what this is effectively telling us in the big picture is that we have a system here that in back testing, if we enter that positive trans criteria that we just talked about and exit on the negative, on the positive GEX, when we hit that point, or if we reverse and drop below this, it actually works out if we do it in a low volatility environment. And the risk to reward ratios are very favorable, and I think it's worthwhile for us to take a look at. So as we draw this to a close here, the key takeaways that I think Mike and I want you to appreciate here is that the spot price crossing PTRANS from below, it has a measurable edge. As tested, take profits when we close above positive gamma. That's what you were just looking at. The low implied volatility areas, they significantly improve the results. So you don't want to do this necessarily when you're coming off a very volatile bottom. You want to let things stabilize a little bit. We've not yet tested fully the equities, but we'll be presenting that. So right now we're using the index ETFs, and I think that leverage ETF discussion that Mike had really helps you think about how you could maybe squeak a little bit out of there. But of course, manage your risk. When you use those leveraged ETFs, you are literally multiplying your gains, but you're also multiplying your losses or potential losses. So you want to be very, very cognizant of that. The key thing for everyone here, all the tools here are available at GammaEdge in the Discord, and you can sign up here to kick the tires and do what you need to do. Mike, anything else to add there?
No, I think this is a great base trading plan for people that are unable to watch intraday and be able to take the entries and exits the next day or even end of day if they're able to watch that. So people that have jobs or other responsibilities, I think this is a great base system to implement and be able to make a reasonable amount of gains for a short amount of holding period.
Great. Well, thanks everyone. Appreciate your attention. If you've made it this far to the end of the video, if you're interested, join us at www.gammaedge.us. That'll take you to a Discord sign-up page. 14-day free trial, all the tools turned on. Everything you just saw in this video is available to you. Not the EdgeRater stuff, of course, but the all the charting and everything. Everyone should be able to get you going there. You can follow us on Twitter or at Twitter with GammaEdges with an S. And of course, here on YouTube, if you like today's content, please like this specific video and subscribe so that you can get notified of the next time Mike and I post something up there. Thanks, everyone. Have a great Sunday.